You're listening to Fund Shack. I'm Ross Butler, and today I'm speaking with Reynir Indahl, founder and managing partner at Summa Equity, a Nordic-based private equity firm which manages Europe's largest dedicated impact fund. Reynir founded Summa in 2016 after migrating from the traditional buyout industry to philanthropy following the global financial crisis. The firm has 50 billion in Swedish krona under management and is investing to solve global challenges. Reynir, welcome to Fund Shack. Your firm, Summa Equity, runs Europe's largest impact fund, I believe. How did you come to set up Summa? What was your thinking behind it? What are the whys?
Well, thanks, Ross, and thanks for inviting me onto your podcast. It wasn't quite obvious when I founded Summa in 2016 that impact and sustainability would be an important category. So I probably have to go a little bit back in why did I arrive at that point? So my background is I studied in the US, undergrad at Wharton, MBA at Harvard, then worked for McKinsey for a few years, went into venture capital, joined as the CEO of a tech company where I lived through a brutal .com crash and all of that, and managed to take it public. And then joined Altor Equity Partners when Altor started up in 2003 in the Nordic.
Yep.
Very successful private equity fund, and we did a lot of mid-market deals, and then the financial crisis came, which didn't affect us that much, but it affected me in the sense that Harvard hadn't taught me anything about the financial crisis potentially coming, so I really started to study why the financial crisis, and then got more and more worried about how our system is creating all these large externalities, both environmentally and socially. And turning 40, I looked myself in the mirror and asked myself if I was part of the problem or part of the solution. And I was sitting there with a few oil and gas service companies, and looking at the portfolio I had invested in, it was quite clear that I was agnostic to these issues, and I wasn't part of the solution. So I decided to leave private equity and wanted to work more with philanthropy and impact. So I joined the board of LGT Venture Philanthropy, which is the Princely Family's foundation for philanthropy, to help develop their strategy around philanthropy and impact. So I was lucky enough then to travel the world and meet with a lot of these sort of emerging, more venture impact funds, and also look at some fantastic companies that were really creating some changes in the local markets. And what I saw was that those that were most financially successful were also the ones having the most impact. But the whole notion then was it was impact first or finance first, in the sense that there's a trade-off between impact and sustainability and financial return, which I didn't see logical. Rather the opposite. I mean, if in the challenges that we have globally now, if you are really going to succeed, you'd rather be solving some of these problems rather than creating it, because the cost will be too big if you are a negative impact company, whether it's carbon tax or whatever. And if you want to really get the best employees and get financing going forward and have a successful company that grows, you need to be solving some of the issues we have. Then you will have tailwind. So hence I decided in 2015, 2016 to go back into private equity and start a fund, a thematic fund around some core thematic areas which we need to solve, the problems that we have. And essentially we were the first called Impact Sustainability Fund in the private equity market. And we committed to the UN Sustainable Development Goals and have used that framework to really assess what problems are our companies solving and how are they solving it and how can we solve it better. So that was a long answer to your question on why starting Summa and how did we kick it off and why.
See, it's easy for me to say, well, obviously, that was the right decision to make. But in 2017 or earlier, when you left Altor, that was a big leap. That was a big risk you took. So you have a lot of personal conviction behind this that I just want to emphasize, I suppose.
A lot of people and investors thought that was pretty crazy. Why start an impact fund in 2016? For me, it was that's what I wanted to do, and it could fail or it could be successful, and I didn't know. So now looking back, it's easy to say, this was a brilliant move and good timing and all of that. It didn't appear like that in 16. But I had enough, so LDT backed us and a few other very credible large LPs
Yeah.
So we were able to, with our thematic approach, also get some really leading LPs on board, which I think a lot of people did not expect this to succeed when I kicked it off.
And you're already onto your third fund, so the first and second must be going okay.
Yeah, so we invested quite quickly. So we have 3 thematic areas. We call them resource efficiency, changing demographics, and tech-enabled transformation. So these are areas that have tailwind growth, and our companies are either solving an environmental problem or a social problem, or providing better governance through SaaS and compliance software. So attractive areas, and we were able to find a lot of excellent companies within those thematic areas. And we were the only impact and sustainability fund. So a lot of the companies also wanted to be owned by someone who was aligned with their mission as well. So we deployed quite fast. Our first fund was 450 million euros. Our second fund around 650 million euros. And we deployed all of that capital within the first 4 or 5 years. And we have returned more investors, more money in Fund 1 than we have drawn down. And we're getting there on Fund 2. And both of them are trading in top quartile. So it's been our thesis was to show that this type of investments and these areas will outperform other areas. So we're glad to see that we have succeeded so far.
So the whole concept of impact is interesting, because you started by saying you were in private equity, then you went through philanthropy, and now you run impact. On paper, an impact fund such as yours, technically speaking, is not really any different to a private equity firm. You're for profit.
Yeah.
You're focused on returns, but not only returns. But you could say the same of a private equity firm. Yes, they're focused on returns, but they need a thesis in order to get there.
Yeah.
And so I was just speaking with a placement agent with regards to ESG and impact, and he said, I think his one bit of advice was, it's less about labeling, it's more about kind of really living the values. Would you comment on that?
I think that is right. I think we have had a huge benefit by being authentic around this since the start. I think it's harder to transition something that where you haven't built it up around the people you have employed, the culture you're making, and the way we are working and operating, and what we're looking for, and what's important to us and our purpose. So I do think it's important that you build it up in the right way from the start. And I do think, we do a lot of what other private equity firms do as well. We have started Summa Foundation, which owns 10% of all of Summa. So we have also seen that we need a non-for-profit arm to solve some of the challenges which cannot be solved in the marketplace. So we do that as well. But the authenticity and the way you build, we have built the organization thematically is different from other firms, because we're not sort of fund structure organized. We're focusing around what problem are we trying to solve.
Yeah.
And we have defined 9, call it problem areas. And then we organized and really working around that. And for each of these problem areas, we are creating a theory of change. So a theory of change basically says, where are we today? Where do we want to be in the future? So we just published ours on circularity and waste now. And what's the theory of change for how to get here to there? And what do you need to believe in, and what do you need to do to make that happen?
So you said you got the 3 thematic areas, which I think is aging population, tech-enabled, and
it's resource efficiency.
And resource efficiency. And so within them, you got another 3, which makes the 9. Is that right?
Yeah, it's
and then within each of the 9, you've got a theory of change.
Yes.
Right. So could you give us an example?
Well, circularity and waste is one area I've been working a lot with, and we have done several investments. One of our first investments was Sortera in Sweden, which we built up to be the 3rd largest recycling company in Sweden, and that we were also awarded the Deal of the Year by Real Deals from as well. So it's an investment we made over 8 times our money on in developing that. When we acquired Sortera, it made all of its money collecting waste. When we sold it, it also made money downstream. So, which means that we have invested quite heavily in the capex to make it more circular and increase the recycling rate. Yeah. Which has a huge impact on both sort of the material security that we have and also CO2 footprint. So then we bought Norsk Gjenvinning, which is the largest one in Norway. And we have a few other companies, TB Auctions, Holbart, which are also in the space of reducing waste or reusing products. So what we now did was to work with McKinsey in order to look at sort of the linear economy today that we have in Europe. What is needed to make it fully circular, based on the technologies that exist today, the different players in industries, and how do we get there?
What does that really mean, though? What's the difference? What does linear and circular mean in that context?
So each one of us have a material footprint in Europe today of 2.2 tons every year. So everything that we consume, but also the cars and houses and everything we engaged in. At the end of life, half of that becomes waste. So 1 ton of waste is generated by you and me every year. So if you employ today the technologies that exist in sorting, in recycling, and in creating useful material out of this, 80% could be in a circular economy instead of only 50% today. So the CO2 footprint today, by half of it being waste at the end of life, and how that is managed and also produced and all of that, is 22% of our CO2 emissions today in Europe. It's a huge number. And if we invested 230 billion euros, we can lower that by 55%, so go from basically 22% down to 10% if we did it now. And 80% of all the material we will be self-sufficient on, which is good from a geopolitical standpoint. And then we took those 230 billion. Where does the need to be invested in CapEx? 50 billion needs to be in better sorting equipment, which already exists. 80 billion in better recycling, and 100 billion is to make useful products like sustainable aviation fuel or biofuels. And if you look at the revenues that should create and the margins and what kind of multiples those companies should trade at, it's a 1 to 2 trillion euro value creation opportunity. So it's a massive, I mean, we can make a 5 to 10 times our money on doing this CapEx and create a lot of jobs and reduce the CO2 so we get back to the 1.5 degree scenario and be more self-sufficient on material. And so 230 billion is more than Summa has. But it's not an insane number. If you look at until 2040, which was the timeline we had, that's essentially less than 1% of GDP that we have to invest in this to create such a massive impact. So that's an area we are super excited around and how we use a theory of change. So if you look at these 230 billion, where do we need to be invested? We have about 30 areas that we have defined as very interesting areas, and we have now a priority on 3 of them. So that's the way we use the theory of change to see where should Summa now invest and what kind of companies should we be looking for, and how can we grow these companies and also enhance what they're doing through CapEx investments, etc.
A figure like 230 billion investment to equal X outcome, it sounds a little pie in the sky, but I think this isn't dependent on completely new technologies. It sounds like you've identified inefficiencies that could be addressed directly with this money. Is that right?
Yeah, absolutely.
Yeah.
And the question is, why isn't it then happening? Well, if you look at the waste management industry, which I know quite well, since we've owned a few companies and own a company in it, it's a quite old-fashioned industry. It's not a high-margin industry either. So how do you get the funding to make these significant investments in the new setups and the new plants and the new technologies? You also then need the customers to commit, or the waste generators. And this has been an area where everyone wants to become more circular, reduce the CO2 footprint. But at the end of the day, even in Norway, it's focusing on price. So if you're a waste generator, all you care about is the price to get rid of your waste.
Yeah.
So why would you pay a premium for it if you don't have to now? So there's changes that needs to happen on getting sort of sufficient number of customers together at a scale significant enough and have them commit and agree, and then also the legislators to be more helping out on aligning the agenda and leveling the playing field. And then I think the banks are quite eager to fund green investments because they also have set net zero targets. So we saw that we refinanced our Norwegian waste and recycling company with a sustainability-linked financing. So the banks are quite open, even in this difficult market, for financing things which helps on the green transition.
To what degree is the impact side of it just a way for you to focus how you invest your money, as opposed to what degree is it kind of measured alongside the financial impact?
Yeah. So since the start, we have been sort of developing our own way of measuring impact, but also then using the new standards that have also appeared along the way. We have, as an example, so we have been part of piloting together with Harvard Business School what's called impact-weighted accounts. So what impact-weighted accounts is takes the externalities, whether that's on the environmental side or social side or product side, and puts a monetary value on it. So our emissions has a cost to the planet. What is that cost? And you can find that scientifically. So there's a market for it, but there's also scientific proofs on what that actually what the cost is for the planet. The same on socially through, if you don't pay fair wages, for example, what is the negative benefit of that? And on the product side, if you have products with a lot of sugar in it, you can measure what the health effect of that is and what the cost to society is for a sugar-based product. So they have developed quite an extensive way of really just translating all of these externalities to a euro figure or dollar figure. What's good with that is that you can compare, you can see, would this company be profitable? Here we have the financial numbers, but if you injected the impact-weighted numbers as well, how would the revenues change? How would the margins change? And the cost in the balance sheet. So you can actually see what the true profitability, if all the both benefits and costs to society had to be included in a financial statement. So
does this make your due diligence process harder, longer, more involved?
It's a brilliant question. The truth is that we are only now starting to do this in the due diligence phase. Because first we had to use the methodology on an existing one, and you do need a lot of data from the companies, especially on the product side, to be able to do it. And so Harvard has helped us with it. They had a team on it. Now there's more consultants that are also starting to use this framework. Now it's easier for us to do it as part of the due diligence. And I think that's the way to go, because we've always said that the management teams and our deal teams, they need to put the sustainability KPIs that we have used for each company and also make forecasts on those. But now it's good to actually have it in comparable numbers. So that is something that we are rolling out, and we have added a few individuals internally and working now with some consultants to help us do that, because it is a little bit more detailed. It requires more in the due diligence process.
Yeah, I can imagine. Yeah. And so the three themes you've got, that which
resource efficiency, changing demographics, and tech-enabled transformation.
Do they link together somehow?
In the beginning, we didn't talk too much about sustainability and impact and ESG, because we really wanted to be in the mainstream. We wanted to get the best in LPs, and we wanted to show that impact is giving better returns. So if you look at these three areas, it's really environmental, social, and governance. So we just put those names on it to make it clear in what thematic areas the companies are.
Okay.
On the tech-enabled side, there is an overlap with some of our tech companies do provide healthcare solutions and also resource efficiency solutions, but from a tech angle. Those that don't overlap with the environmental and social side is compliance software. So we have had several companies which are compliance software to be compliant with the regulatory regime.
Yeah. And what about the aging populations? What's the financial?
So we have been focusing on healthcare and a subsector of healthcare called the omics space. So really the area which is providing the tools for understanding our body in a better way. And so on the social side, we could have done other areas as well. So we are quite narrow within that. But education would fall within it. Security, you have other adjacent areas which have a lot of social benefit and social impact.
Yeah.
So we have just tried to be really good at what we are doing. So hence we have been more focused and quite narrow in some of these areas. And on the changing demographic side and the healthcare side, we've been super narrow in what we have been focusing on.
Yeah, and there's more. So when you started out, impact was you were out there, but now you could almost call it mainstream. You got a lot of the big asset managers with impact funds and many impact funds. How's this changed things, the competitive landscape, and presumably in one sense it's easier because it's easier to sell something that everyone knows about and it's mainstream, but in one sense might be harder.
Yeah. Well, first of all, I think it's fantastic that this is becoming more and more mainstream, and I think all investors need to think about impact. All companies have impact, positive or negative, and I think you need to be aligned that in the right way if you're going to create returns going forward. So I cheer on everyone that is now being explicit going into that area. I think in a few years, impact is not going to be a separate category. It's going to be fully integrated. And we call it private equity 4.0. We have gone through a transition in our industry from the Barbarians at the gate, private equity 1.0, to more focusing on operating improvement, and private equity firms added the operating partners. That's the sort of 2.0. To many of the private equity funds starting to compete against corporate buyers, and hence having to be more focused on industries and also growing and become large one and more institutionalized players. But in all of these areas, impact and sustainability didn't matter. Externalities didn't matter. And we think that has fundamentally changed now. If you're going to get the best employees, if you're going to get financing for the companies, if the companies are going to succeed, they will be hit with either some penalties for the negative impact they're having, or they're going to benefit from having positive impact. So I think this is going to be, it's going to disappear as a category as such. And I do get the question that you just posed from a lot of our LPs. So we have a lot of advantage of being the first and authentic and building up Summa around this thesis. But now everyone seems to be doing it. So are you losing your advantage? And my reply to that is that that's why we have become a bit more narrow in which thematic or problems we're trying to solve. So we want to be the best within waste and circularity. We want to be the best within food and agri. We want to be the best in omics. We want to be the best in compliance software. So our teams have started to focus, and that's why we're creating this theory of changes, why we have added some really unique thematic partners who know these industries and thematic areas extremely well. So I would say when we look at companies now, I don't meet any of the other impact funds in the companies. There's some that are more auction based, but we have a lot of proactive deal sourcing. So we will meet some in some of it, but in general, I don't feel that the competition has increased. But that might be just because we have become more narrow and more specialized.
Yeah, I wonder what the risk profile of impact funds is, because it's one thing, assessing the financial performance of a company 5 years after you've applied your value creation toolkit, but it's another thing because almost by definition you are dealing with companies in areas of great change. And that doesn't mean they're not like venture-backed companies, but their broader environment is either dependent on a rapidly evolving regulatory environment, for example, or a rapidly evolving consumer perception context. And I suppose it's an unanswerable question, but it's an interesting one, I think. What the risk profile might be.
In the sense that we have a quite traditional approach, in the sense that the companies we're looking at, it needs to be net positive in the sense that it has to solve some problem already today. We don't want to do a turnaround on that. And then it's about building on it and growing it. We don't factor into our base cases that we will get a regulatory change during our ownership period. So if that happens, it will benefit our companies because they are in areas where regulation needs to be improved. And since we're already on the positive side, that will only accelerate and make a more level playing field. So I would say the risk is lower, and if you look at the companies, we just announced 2 exits that we've done, and if you look at all of our exits, we have averaged around 4 times the money on those investments, and they have been at a premium to our latest quarterly valuation, so our net asset value on those assets. And we have a traditional approach looking at sort of the peer group, listed peer group, taking a discount to it. That's the valuation of our companies. And basically all of them have been sold at a premium to the peer group. So I think the market is recognizing that these are companies that are growing well, they're doing something positive, so they are future-proof in that sense. And there's lower risk just because you know that this company won't be disrupted by a carbon tax or something that might come. So I think actually from what we're seeing in our portfolio and the companies we're looking at, they're lower risk.
What's your geographic remit?
Mostly focusing on the Nordic. We opened an office in Munich, so we're looking at the DACH region as well. But as we have become more focused thematically, I would say we look at companies also outside our core geographies, but only in areas where we have unique competence and knowledge.
Do you have like a value creation playbook or toolkit that you typically employ, certain techniques?
Yes, we do, but I don't think it's that different from what other private equity funds do. The 100-day plan or the 5-year plan or whatever private equity firms call it, we call 3-phase plan. So we look at the company in phase 1 is the first year or 2 we own them. How can we just improve them based on what they're already doing? I think most private equity firms do that. That's essentially the 100-day plan. Phase 2 is 2 to 5 years from now. Where is 20% of their revenues coming from, which they don't have today? That could be a new geography, it could be a new product. At the same time, it also has to high grade what they're doing. So if you look at the waste and recycling companies, that's what we looked at for Sortera and we're doing with Norsk Gjenvinning, is how can we increase the recycling rate so that they are more sustainable? So then you have to do some investments in CapEx and maybe acquire some companies in areas that you're missing. And then phase 3 is really forward-looking. So the theory of change we've done on circularity in waste is really looking into 2040, having a circular economy. If you own a waste management company and you're not doing anything to get to the 2040 target, you will be out of business because there's hardly any waste. The feedstock will become quite valuable. So your business model will be disrupted. So we look for each of our companies at, how can they be a leader? And that's where the theory of change comes into setting that sort of both time set and where are we then? And what do we need to do of changes now? And all this phase 1, 2, and 3, you have to work on all of them at the same time. So of course, most of the effort goes into phase 1 when you're in phase 1. But if you're not doing anything on phase 2, you will never get to the 20% revenues in 2 to 5 years, right? So. And the same with phase 3. What you're doing in phase 2 should be the stepping stone. We're leading the way into phase 3.
I suppose when building a company like Summa, it's different, slightly different perhaps to a purely financial focused private equity firm, because then you're just trying to attract the brightest graduates who are obviously self-interested, as we all are. But you have there's an impact overlay. How has that affected how you've built your firm and how you build and create the culture and maintain it?
So the purpose of Summa is to invest to solve global challenges. So we had that since the start. And our purpose is very, very important to us. So we have to be convinced of the people we're bringing on board that you're genuinely interested in solving the challenges that we're facing. So you're not purely doing it to get into private equity and make money. So everything starts with a purpose. That's why also we set up Summa Foundation to also be a part of giving. So essentially, all of us have to do a 10% cut of what we otherwise would make in a similar private equity firm, because that's all going to philanthropy. So we do then have lower compensation in Summa than a comparable private equity firm due to that. The second part is that what kind of people are you bringing around? Because we are trying to go on a new path that there aren't many examples of how you do it. And some of these challenges, you really need different perspectives on it. When you're not only focusing on phase 1, you are focusing on phase 2 and 3 and the theory of change, you need to bring in other perspectives as well. So diversity has been extremely important to building the organization. The third thing that has been important to us is transparency and honesty. So all these things go both internally and externally. So we We don't want to greenwash anything. We want to be open about the challenges that we're having, and we want people to bring their whole self at work as well. So let's create a culture which is, we are very, very team-based. And it's quite an integrated team with the Via Summa, which is the value creation team, the impact team, and the thematic deal team. So a lot of these theory of changes, the thesis, and when we are looking at companies, and also figuring out how Summa can be better, is very, very integrated. We trying also to create the psychological safety. It's not that easy always. I mean, there's always challenges, and but really, how can everyone feel comfortable about speaking up when there's not something that isn't working? And how does people take entrepreneurship and just solving it instead of complaining about it? So, and I think, that aligning around the purpose, we all know why we're here.
And being solutions focused rather than just moaning.
Yes,
sounds good to me.
And we know what's important and our core values. So,
so I was just speaking with a placement agent, and he said it's amazing how many private equity firms, obviously they're very focused on value creation in the portfolio, but they never look internally at their own management structure, which is obviously what investors are also very interested in. It's like you can't, and in some senses, you can't really be a truly effective external manager unless you are honest with yourself about how you are managed internally.
Yes.
So can you give me an example of what you've done practically recently to sharpen up your internal processes?
So we've been working with Thematic, who you also know, on developing a way to measure this. So we roll that out across our portfolio, and we run it internally on Summa. So we shouldn't ask our companies to do anything that we don't do ourselves.
So this is about effective behavioral.
Yes, it's a behavioral assessment, and that's all what it's about. And there's always room for improvement in various processes and how you go about things, how you gather information, how you make decisions, etc. So it's super useful in, and also that we can learn from our companies, and we have some amazing ex-CEOs and thematic partners on board. Which is a fully integrated part of the partnership, where we can we look at the data, we evaluate our processes, and we try to be better.
So your latest fund is an Article 9 fund, and that's relatively recent regulation. How did you find fitting into that box?
There has been a lot of talk around that some of the areas within Article 9 isn't fully. Not everyone agrees on. What does that mean? What's a substantial contribution? So we've also published a little bit of our methodology around it.
Right.
There was a lot of funds that were starting to downgrade from Article 9 to Article 8 because it's just unclear.
Yeah.
And I think that is a pity. In the circularity and waste work we've done, we see a lot of the issues today are more in the whole brown to green transition. So it's that's where it's making it a bit challenging to be Article 9, because we can't buy a brown asset, although we can transition it to green quite quickly. We can buy sort of grey assets, and that are sort of. But one example which would be difficult now as an Article 9 fund is waste incineration. So when you incinerate waste today, 1 ton of waste creates 1 ton of CO2. So the EU taxonomy has excluded it now, and this happened a couple of months ago, from the green taxonomy. So it's a brown asset is going to be hit with carbon tax, all of that. And there are ways to transition them to green, both to carbon capture and also newer technologies So one interesting area, what we need to do is we have 3,000 waste incinerators in Europe. They need to be transitioned to green. So that is an area where we would like to invest and be part of.
Yeah.
So if we do that, we will have to look at starting an Article 8 fund.
Oh, right.
But that's where the big, if we are going to decarbonize, we really need to transition the brown to green.
Yeah. It seems slightly bizarre that you'd need to downgrade in order to upgrade the actual facility.
Exactly, to actually make them green.
So you mentioned kind of your vision that you hope, in the near future that there won't be an impact thing because everyone will go in this direction. But what about Summa Equity itself? What's your medium term ambition for your firm? Where do you hope to be and take things?
Yeah, I'm super excited about how we have been much more specific around what challenges we want to be part of solving and how we go about doing it. And I think, then having a 2.3 billion euro fund now gives us more muscle to lean into some of those problems. So in the circularity and waste, as I mentioned, I would like to find a way of playing in the sort of brown to green transition as an area we know very well now. We have companies in this area, and we have Bertrand Camus joined us as a partner. He is the ex-CEO of Suez. And when Suez and Veolia merged, he left and then he joined us, and he's super knowledgeable in this whole field and area. So I think it's just we are focusing more and more, and then we might need sort of other funds then to be able to invest in an Article 8 brown to green transition. Yeah.
Well, it makes sense as the as this part of the market matures that it becomes more specialist.
Yeah,
that's the way the rest of the market's going.
Yeah.
So, well, I mean, good luck with it. Thank you very much for coming on and sharing your thoughts. And maybe you come back in some time and tell us how it's going.
Well, it's great to be here. So thank you.
You've been listening to the Fund Shack podcast. It's the private capital channel for alternative investment professionals. This podcast was designed and produced by Linear B Group, a leading content marketing agency focused on financial and professional services. Thanks for listening.